All right, class, I just wanted to give you a brief overview of the valuation report template that you'll be using to turn in each of your milestones and ultimately your final milestone. So here's the cover page. Obviously, you'll change this name to your company name. Here's a table of contents. Now, as you update your different sections within the report template, you'll want to come back here and update your page numbers. So this will automatically update. So first of all, you'll be covering a basic overview of your company, which has covers the nature, background, and history, facilities, competitors, major shareholders, etc. Then you'll be touching on the financial piece, which covers the income statement, balance sheet, and then of course any normalization adjustments that you will make. You'll need to make to that. Then, as we talked about in prior milestones, prior weeks, you cover your industry analysis, which gives an in-depth or a summary rather of your particular industry. You'll talk about the general economy, GDP, macroeconomics. And then you'll go into the business valuation piece of it, where we talk about each of the three approaches. Again, we're only going to do the income approach during this class, so we'll calculate the prospective analysis. You'll talk about the discount rate, and then actually calculate or discount those projections to present value. Then, of course, we'll talk about the discount for like a control, discount for marketability. We're really only going to mention this term and provide an overview of them. We're not going to go into all of the research required to actually calculate these, simply because we don't have access to most of the data that's required to do that. But I still wanted to get you familiar with the concepts, and then we'll apply it just using a standard discount that I provide to you. And of course that comes to your final calculation of value. All right, in the report we have these different sections, and underneath those section headers, I've got a little blurb here that starts with guidance here in green, and sort of gives you an idea of what you should be providing under that. It gives you some pointers. So when you get lost, you can refer to that, or you can always reach out to me, of course. And there will be this section underneath each one of these. This write-up, and you'll just remove this after you've read it, select your own content there. And so these financial statements that are going to be inserted, these are coming from your model. So with that, let me switch over to the actual model you'll be using. So this is the model. I would start out on the summary tab here, because it gives you an overview of each one of these different tabs, because you have to fill out each one of these tabs. And it'll give you a little bit of context and a little bit of direction. So let me just start here. All right, so you've got the balance sheet tab, then of course we have income statement. We have ratios tab, which is automatically calculated as you fill in these numbers, the balance sheet and the income statement. Then we have the prospective analysis, discount rate, DCF or discounted cash flows, and then valuation summary. Let me just briefly go through each one of these tabs. Okay, so you will look up the financial statements for each of these years for your company, and you'll just fill these out. Okay, and then as you fill these out, the common size numbers or ratios will automatically populate over here to your right. Same thing with your income statement. And down here we have a little section for normalization adjustments that you will make if you need to make any. And once you fill these out, the ratios tab will automatically begin to populate. And really the main thing I would say that this tab is for is just helping you explain or helping you, giving you write-up material. So you can go in and say, all right, well, this is what my current ratio is doing. How does that compare to the industry? What does that tell me about my company? You can do that for each one of these. All right, so once you've done the historical balance sheet and income analysis, income statement, you will create your projected income statement. And then the income statement feeds into, or the projected income statement feeds into this tab, which you will then make adjustments to arrive at cash flows, future cash flows. So you're adding back depreciation. You're removing any capital expenditures that you project the company to make. And then, of course, taking out any sort of debt reduction that the company plans to make if they're going to retire debt. That gets you to future projected cash flows. And we're only doing this for 5 years, but note that then we do a terminal year after we've done the 5 years, and then we discount that to present value after we capitalize it. So what we do is we capitalize the last year, which all you do to capitalize is you take the discount rate, which we came up with in the prior tab. Okay. So we are capitalizing the terminal value to give us a figure here, and then of course we're adding all of the future cash flow present value numbers down here. So that's where that comes from, and then we add the sum, or we add the net present value of terminal cash flows. So we're adding both of those figures to arrive at a total or a single value calculation there. All right, and so that gives us a number, which then flows over into this tab. We then we apply a discount for lack of control, a discount for lack of marketability, and then that gives us a final value, and then we take a percentage. So if you're assuming that if you're assuming that we are valuing 1% of the company, then which we're going to in this case, then you'll just take that number that has been discounted, or that has discounts for lack of control removed and discounts for lack of marketability removed. You will just take 1% of that to get you a 1% interest for your company. And one thing I want to make sure I cover real quickly is the discount rate. So these are all the different components. You don't necessarily have to change these if you don't want to. This really is beyond the scope of this class, but I wanted you to at least understand the different concepts that are, or the different factors that that make up the discount rate. So you're welcome to just use this 10.6% if you want to, or you can try to go in and update these figures. That's really up to you. There's not enough time to cover this concept in the class. All right, that's it. Let me know if you have questions, guys.